Hello and welcome to Beyond the Charts. This series is where we break down what's happening in the world of finance and the economy through charts in a way that's easy for you to understand. For all the charts and sources mentioned in this video, check out our newsletter. The link is given in the description below. Here's a piece of geography most people never really think about until suddenly it starts showing up everywhere in the news: the Strait of Hormuz. See, it's a narrow stretch of water between Iran and Oman, which is barely 33 kilometers wide at its tightest point. But despite how small it looks on the map, it carries an enormous amount of the world's energy. On a normal day, around 20 million barrels of oil passes through this corridor along with roughly a fifth of global LNG supply. In other words, a huge share of global energy trade depends on a shipping lane that in places is narrower than many cities are wide. And that's why the war that erupted at the end of February quickly became more than just a regional conflict. See, after coordinated US Israeli strikes on Iran and Iranian retaliation across the Gulf, activity in the Strait of Hormuz, which is the main artery to which Gulf energy reaches the rest of the world, started to slow. Ships started moving, insurers pulled back, tankers began waiting outside the strait instead of sailing through it. And that's how a military conflict suddenly turned into a global economic story. When so much of the world's energy moves through a single narrow passage, even a small disruption is enough to shake the markets. Now, according to Goldman Sachs, nearly 20 million barrels of oil moves through the Strait of Hormuz every single day. In 2025 alone, about 13.4 million barrels per day of crude exports passed through this route. Most of that came from three countries: Saudi Arabia, Iraq, and the UAE, which together accounted for roughly 13.1 million barrels per day of these flows. See, in theory, some oil can bypass through the strait through pipelines, but in practice, the capacity is limited. The International Energy Agency estimates that only 4.2 million barrels per day can be rerouted through these alternative routes. And oil isn't the only commodity that moves through Hormuz. Goldman Sachs estimates that roughly 80 million tons of LNG passes through the strait every year, about 19% of global supply, with most of it coming from Qatar. The first thing to understand about a disruption in the Strait of Hormuz is that it starts as a logistics problem. The oil may still be produced, it just can't move. Alliance Research noted that in the early days of the conflict, more than 200 oil and LNG vessels were anchored outside the strait. Insurers and ship owners were simply unwilling to take on the risk of sending ships through an active conflict zone. But logistic shocks can quickly turn into supply shocks. If ships stay stuck for long enough, export terminals start filling up, storage tanks overflow, and producers eventually have to slow or cut production. According to Goldman Sachs, global visible oil inventories currently stand at around 7.8 billion barrels, which is roughly in line with historical events relative to demand. The bank also estimates about 3.7 million barrels per day of spare production capacity worldwide, most of it concentrated in Saudi Arabia and the UAE. These buffers can help the market absorb a short disruption. They don't last forever. If the Strait of Hormuz stays disrupted for long enough, those buffers begin to run out. And at that point, what started as a shipping problem turns into a real supply shortage. One part of the Hormuz story that often gets overlooked is that the strait isn't just an oil route. See, the Gulf exports far more than just crude. Petrochemicals, refined fuels, fertilizers, aluminium, plastics, and a range of other industrial products all move through the same corridor. So when tanker traffic slows, it's not just oil shipments that get disrupted. Many of these exports are affected as well. ING notes that if the disruption drags on, the impact won't be limited to oil prices alone. It can create a broader trade shock which might lead to higher energy costs, lower shipping routes, rising insurance premiums, and slower global trade. Some Gulf producers do have limited ways to bypass the strait. Saudi Arabia and the UAE, for instance, operate pipelines that allow some oil to reach ports outside Hormuz. But the capacity is limited. ING estimates these routes can divert roughly 5 million barrels per day. Even after that, around 15 million barrels per day of oil supply would remain exposed to that strait. And that's exactly why these bypass routes reduce the severity of the shock but don't remove it entirely. In fact, there's another complication. Much of the world's spare oil production capacity also sits in the Gulf, as we saw earlier. So, even if producers decide to pump more oil, it still has to move through the same vulnerable corridor. And while oil usually dominates the headlines, gas markets could feel the sharper impact. Goldman Sachs estimate that roughly 80 million tons of LNG that normally passes through Hormuz accounts for nearly one-fifth of global LNG supply. See, the effects of a Hormuz disruption doesn't just stop with energy prices. They also ripple through the global shipping. Goldman notes that crude freight rates were already about 50% higher this year, even before the latest escalation, while some tanker routes have reportedly tripled in cost as war risk insurance surged. Alliance also adds that fuel accounts for roughly 35% of a ship's operating costs. So if fuel prices rise by 40 to 50%, freight rates could climb another 15 to 20%. And because shipping costs feed directly into the price of traded goods, those increases eventually show up as inflation. Goldman's macro analysis gives us a rough sense of the scale. In its baseline scenario, the shock adds about zero point 0.2 percentage points to global inflation and reduces global growth by around zero point 0.1 percentage points. Now, in a more severe scenario where oil moves closer to $100 per barrel, inflation could rise by about zero point 0.7 percentage points, while global growth slows down by roughly zero point 0.4 percentage points. For India, the exposure is significant. The country imports around 85% of its crude oil, and roughly 40% of those imports pass through the Strait of Hormuz, as per ING. Now, that simply means higher oil prices can affect India through several channels at once. Higher import bills, wider current account deficits, more inflation pressure, rupee volatility, and potentially tighter monetary policy. Standard Chartered adds another dimension to this. According to the bank, roughly 20% of the Indian equity market is negatively exposed to higher oil prices, which makes this not just a macroeconomic issue but a market one as well. That's it for this edition. Thank you for watching. Do let us know your feedback in the comments below.